I'll start by saying that, in normal times, economic forecasting is about pattern recognition. But these aren't normal times. And I think there are patterns to be recognized. And Adam will talk more about that in a minute. But they're not the ones that are in the standard economist toolkit. That said, I think it's really clear that the outlook for global growth has weakened markedly in recent months. Here's my global forecast under the assumption that the tariffs currently announced by the Trump administration are mostly kept in place, maybe with some retaliation. A lot of countries are going to experience a significantly slower growth in coming quarters, and we'll see global growth that is about half a percentage point lower than it was last year and only a little stronger next year. I'm not going to offer you specific numbers for other major economies other than the United States, because I think that would just give you false confidence in how we think things are playing out. It's too much precision. But I'll give you some broad thoughts. So United States, I'll talk much more about that in a minute, but basically it's a story about a solid foundation giving way to stalled economic growth and higher inflation. Our trading partners in North America, they're going to be hit hard by higher U.S. tariffs. I think Mexico is particularly vulnerable between their weaker fundamentals, the worst terms they're likely to see in the USMCA revisions. There might be some upside related to nearshoring, more nearshoring, given the recent escalation and trade tensions with China. Europe and UK, some green shoots there. I think we'll see positive, albeit subdued growth in Europe and the UK. I think the euro area in particular, is going to benefit from common action on debt issuance and increased defense spending, and Jacob will be talking more about that. As for China, I think growth is likely to fall well short of the 5% target. I think a number more like 4 is more realistic. They're suffering from ongoing structural challenges, incredibly heightened tensions with the United States over trade. And people have made the point that the government can stimulate, but the household response to stimulus just hasn't been very strong. Asia outside of China, exposed to risks from potentially large increases in U.S. tariffs. We'll have to see how the negotiations about the so-called reciprocal tariffs play out. Within Asia, I think India remains a bright spot. They're continuing to draw in foreign investment, even though they'll see higher tariffs. And then for other emerging market economies, it's a grab bag. They're all kind of face their own unique challenges, I will say. I think they're all going to suffer from tariff-related drag. Some might benefit from some more nearshoring, but I think this is all going to be amplified for them by a slower global growth. Okay, so the main reason for these changes is U.S. economic policy, so I'm going to spend a few slides going through that. Tariffs are, of course, the big story. We've seen a very large increase in tariffs that Chad's going to talk about in a minute, but basically going from a 2.4% average rate to something like 15 or 20%. As PIIE analysis has emphasized in the last couple of years, the tariffs are going to raise prices. That's going to reduce real incomes. That's going to disrupt supply chains for businesses and cause businesses to reorganize. That's all going to be bad for economic growth, but I think kind of a big deal in recent weeks is just the whipsawing of tariff policy has just created this surge in economic policy uncertainty, and that is going to have a meaningful effect by itself on economic growth in this country. Changes in immigration policy are also a big deal. Last couple of years, as you can see on the right, we've had the surge in immigration, and that has actually allowed the economy to grow at something that's like 3/4 percentage points above where we thought trend was, while still enjoying kind of a decline in inflation. We don't have a lot of hard data to go off of. The numbers around immigration or net immigration are just lacking, but as you can see in the slide on the left here, we know that border crossings have plunged to something like pretty close to 0. We also know that up to 1 million people are going to lose their temporary protected status. That's going to lead them to drop out of the labor force and maybe self-deport, and then there are going to be the deportations by the government. all told, I have immigration declining to 500,000 this year. And that, even in the absence of tariffs, that would put a cap on growth just because of its effect on potential labor supply. There's been a lot of discussion about the Department of Government Efficiency, DOGE. A lot of people have noted that the DOGE layoffs, despite all the news they're getting, that they're not large relative to our labor market. Likewise, they're not going to do much for the budget deficit. The shorter bar that you can see in this chart here is my estimate of the compensation savings you'd get from cutting half of the federal civilian labor force. I think that's a vast overstatement relative to what we're actually going to see, maybe 3 times as large. But remember, we'll see a lot of contractors lose their jobs as well. But you can see how short that bar is relative to what I've got on the right, which is the Committee for Responsible Federal Budget's estimate of the amount of deficit reduction we need on an annual basis to keep debt to GDP at 100%. So it pales in comparison. DOGE is also not going to be good for productivity, either over the short run or the long run, given the operational disruptions in the near term, and then cuts to research and development that are going to impact things over the longer term. And then the last big piece of US policy, of course, is the coming fiscal package. This slide here just shows you what I think is going to happen. On the tax side, the likely big change is the extension of most of the expiring 2017 tax cuts. There'll also be a few changes related to campaign promises. In the middle column, likely changes on the spending side. Here, I think the biggest change will be cuts to the Medicaid program. And then the last column, I talk about the effects on aggregate demand relative to current policy. And here, I think it's a small net negative effect, because extending those tax cuts just retains the same level of fiscal support. And then you have these spending cuts that are going to slightly outweigh the additional tax cuts. As I note in the banner stretching across, in terms of deficit reduction, of course, tariff revenue is going to help maybe a bit with that, maybe a couple $100 billion. But that, as I've already said, that's going to reinforce the negative demand effects, especially because it shifts, collectively these actions shift the tax burden to people with higher marginal propensities to consume. And that's been emphasized in some work by Kim Klossing and Maury Obstfeld here at Peterson. Okay, so given all these changes, here's where I'm landing. You can see my forecast for quarterly GDP growth in the chart in this picture. And what you can see basically is a stalling of economic growth this year. I've got one quarter of negative growth, but basically I've got on net output almost unchanged for this year before increasing again next year. On the right, I have a table with some specific numbers. I'm going to talk more about unemployment and inflation in a moment, but I've got inflation peaking at 4% for the year as a whole. On a quarterly basis, the peak is going to be 4.5%, and the unemployment rate rising to 5%. So let me just take a couple of slides now and talk about what we're seeing so far, because I think that's actually really important to thinking about how the Fed's going to respond to this all. So markets are reading these policy changes as a big negative for the US and global economies. You can see the huge drop in stock prices on Liberation Day. A little bit of rebound since then, but stock markets are down on net. On the right, I've got the dollar index, and I think this one's a really interesting one because, we teach our students that if you put down big tariffs, it's going to raise the value of your currency, and instead we've seen the value of our currency fall a bunch, and I think maybe that's partly related to weaker prospects for the US economy, but it's also related to this loss in appetite for US treasuries and other US assets. And I think that's potentially a big deal, and I'll come back to that when I talk about downside risks. In terms of hard data, we really don't have much suggesting a fall off in demand. I've got non-farm payrolls up here in the chart. You can see the strong reading we got for March. Really, that report as a whole was a very solid report. And then you've got the spending data, and there I think it's really clouded because you've got maybe a pullback related to all the forces I've already talked about, but it's clouded by people pulling forward their purchases on both the household side and the business side ahead of tariff-related price increases. We saw that, for example, with motor vehicle sales in March, which popped up. Soft data shows more of a weakening. So on the left here, I've got the PMI, the new orders index, and you can see, striking declines in the last couple of months. I think the services component is particularly interesting. These are at the low end of the range for recent years. Consumer confidence has plunged. I'm sure people know about that. There, I think you should take the surveys with a bit of a grain of salt. I mean, I think some of it is going to be reflected in how people spend money, but I also think there's a strong partisan bias, which you can see in the slide I've got up here. You can just see just this enormous difference between Republicans and Democrats. And so I think it's partly speaking to people's actual planned behavior, but it's also partly speaking to the media that people are consuming. So I'm putting more weight on business surveys these days. And then quickly, the last piece of data I want to emphasize was just what we've seen on inflation. The March CPI report was just very benign. The trends are moving in the right direction, but inflation as a whole is still above the Fed's target. And I think that's the main point here, which is particularly for services and for services outside housing. What you can see is that we are actually starting at a point that's above where we were prior to the pandemic. So the tariff-related increases are going to build on that. Okay, so, given all this data, you can see why it is the Fed seems to be leaning on incoming data and why, and how they're describing themselves as kind of feeling themselves forward. I think the Fed's also going to be challenged by inflation expectations. I think they care a lot about whether inflation expectations are going to become unmoored, but we just don't have great measures of inflation expectations. And to make that point, I've actually plotted 4 different measures of median 12-month ahead inflation. So conceptually very similar, and you can just see this huge range that we're getting from these different household surveys. And this is over the 12-month horizon. So I think the longer term horizons, it's even worse in terms of measuring inflation. I think the monetary policymakers are also going to be challenged by really not knowing where the neutral policy rate is. FOMC members suggest that the current setting is well above the neutral policy rate, but I think there are a lot of reasons to be skeptical about that. And I think kind of this loss of appetite for U.S. assets is going to basically reinforce that, implying a higher neutral rate. Anyway, where I think the Fed is going to come out is I think they're going to hold steady basically until the end of this year. They're going to be weighing this higher unemployment against higher inflation. But with inflation going up to levels that are going to be well above target and fears of expectations becoming unanchored, I think that's going to discourage cuts. So I think basically what's going to happen is we're going to see the unemployment rate rising, and eventually that's going to induce some easing once the higher frequency, the quarterly inflation readings appear to be subsiding. So this just summarizes my inflation and unemployment forecast. As I said before, I've got later this year, I've gotten core inflation peaking around 4.5% before things start to subside, because those price increases from tariffs, they will eventually pass through the system. And I've got the unemployment rate rising and then starting to decline again as those price increases subside and stop demand destruction, but also because of the Fed cuts. Last thing I want to do is just talk a little bit about risks. So I think there's I'm not forecasting a recession, but their odds are higher than they normally are at 40%. I think there are lots of channels through which economic weakness could be amplified. A larger stock market decline than what we've already seen. We really don't know whether the degree to which the market was overvalued, as we embarked on this whole episode. So I think there is risk there. Big one, a loss of confidence in U.S. fiscal management due to, large budget deficits, general chaos, and breakdown of institutional norms could cause, a big spike in our interest rates. And then lastly, a need for the Fed to tighten policy if the high inflation doesn't subside, as I think it will, and looks to become self-sustaining. Now, the last slide I just want to put out there is there upside risk? And I would say yes, there is upside risk relative to the forecast I have here. The administration would have to materially reverse its tariff increases. But if that happens, remember I talked about the solid foundation we're building off of. You've got AI innovations on top of that, deregulation that's coming, investment tax incentives that are coming. Generally, business animal spirits could be restored, and this could sustain strong productivity gains through more investment. It could restore solid growth. All that said, I think the immigration policies of this administration are not going to reverse. So you're still going to have a cap on growth. Growth is going to be growth above 2.5% is just highly unlikely at this point. So that's everything I have to say. And with that, I'm going to close out and turn things over to Chad.